If you're in your 50s or early 60s and making over $200,000, there's a good chance you're getting absolutely hammered by taxes every year. And here's what's really frustrating. Many of the people I begin working with at Trillo Wealth are leaving thousands of dollars on the table simply because they don't know about 3 simple tax moves they could be making right now. As a financial advisor with over 10 years of experience, I've seen too many successful professionals miss these opportunities year after year. The difference between someone who implements these strategies and someone who doesn't can literally be tens of thousands of dollars in tax savings. In today's video, I'm going to walk you through 3 straightforward tax planning moves that can help you keep more of your hard-earned money before you retire. These aren't complicated schemes or risky strategies. They're simple, IRS-approved methods that every high earner should know about. I'm here to help families and retirees simplify financial complexity with personalized planning so they can move into retirement with clarity, confidence, and peace of mind. Let's dive into these 3 game-changing strategies. The first move is probably the most obvious, but you'd be surprised how many high earners aren't taking full advantage of it. I'm talking about maximizing your pre-tax retirement contributions. For 2025, the 401k contribution limit is $23,500 with an additional $7,500 catch-up if you're 50 or older. That means if you're over 50, you can contribute up to $31,000 to your 401k this year. Let's walk through a hypothetical example. Imagine you're 55 years old, making $250,000 annually, and you're currently contributing the company match of 6%. That's $15,000. You're missing out on an additional $16,000 in contribution. That could save you roughly $5,280 in federal taxes alone if you're in the 33% tax bracket. But here's where it gets really interesting for high earners. Many of you also have access to additional tax advantage savings vehicles that most people don't even realize exist. First, there's the traditional IRA. Even if you can't deduct IRA contributions due to income limits, you might benefit from a backdoor Roth conversion strategy. For 2025, you can contribute $7,000 to an IRA or $8,000 if you're over 50. Second, if you're self-employed or have 1099 income, you might qualify for a SEP IRA, which allows you to contribute up to 25% of your income or $70,000 for 2025, whichever is less. Third, don't forget about health savings accounts. For 2025, you can contribute $4,300 for individual coverage or $8,550 for family coverage, with an additional $1,000 catch-up contribution if you're 55 or older. HSAs offer triple tax advantage deductions, deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Here's what I often tell my clients. If you can afford to retire comfortably, you should be able to afford maximizing these contributions. The tax savings alone often make it worthwhile. The second strategy is tax loss harvesting. This is where we can get really strategic about timing your investment decisions. Tax loss harvesting involves selling investments that have declined in value to realize losses that can offset taxable gains elsewhere in your portfolio. For 2025, you can use investment losses to offset capital gains dollar for dollar. And if your losses exceed your gains, you can deduct up to $3,000 against ordinary income. Here's how this works in practice. Let's say you have a stock that's gained $10,000 this year, but you also have another investment that's down $8,000. By strategically harvesting that loss, you can offset most of your gain, reducing your taxable income. But here's the key. Timing matters enormously. I often see people make one of 2 mistakes. Either they never harvest losses because they're emotionally attached to their losing investments, or they harvest losses randomly without considering the bigger picture. The smart approach is to review your portfolio regularly. I recommend at least quarterly, and look for harvesting opportunities that align with your overall investment strategy. This is particularly powerful in volatile markets where you might have significant swings in individual positions. One important caveat. Be aware of the wash sale rule. If you buy back the same or substantially identical security within 30 days of selling it for a loss, the IRS disallows that loss. But you can buy similar, not identical investments to maintain the same market exposure. For example, if you sell an S&P 500 index fund to harvest losses, you could purchase a total stock market index fund instead to maintain similar exposure while avoiding the wash sell rule. The third strategy is all about timing, specifically the timing of large income events to avoid unnecessary jumps into higher tax brackets. This is particularly relevant if you have stock compensation, bonuses, or other forms of variable income. The key is understanding where you sit in the tax brackets and being strategic about when you recognize the income. For 2025, the federal tax brackets are 10%, 12%, 22, 24, 32, 35, and 37. If you're married filing jointly, the 24% bracket goes from 383 up to, and the 32% bracket starts at 383,901. Let me give you a hypothetical scenario. Suppose you're expecting a $50,000 bonus. Your regular income already puts you near the top of the 24% bracket. If you receive that bonus in the same tax year, a portion of it gets taxed at 32% instead of 24%. Depending on your situation, it might make some sense to defer that bonus to the following year when you might be in early retirement and in a lower bracket overall. This is especially relevant for people planning to retire in their early 60s. Another common situation involves Roth conversions. If you're planning to do Roth conversions in retirement when you're in lower tax brackets, it might not make sense to do them while you're still working at peak earning years. The same principle applies to capital gains recognition. If you're planning to realize significant gains from stock sales, consider whether it makes sense to spread them across multiple tax years or time them for years when other income is lower. Here's a strategy I often recommend to clients. Create a multi-year tax plan. Don't just think about this year's taxes. Think about your situation over the next 3 to 5 years as you transition into retirement. What makes these strategies truly powerful is when you coordinate them together rather than treating them as separate tactics. For instance, let's consider a hypothetical situation. You're 58 years old, making $300,000 a year, and plan on retire at 62. You have some company stock that's appreciated significantly, but you also have some positions that are underwater. By maximizing your 401k contributions, you reduce your current taxable income. Then, by strategically harvesting losses, you can offset some of the gains when you sell the appreciated stock. And by timing the stock sale for a year when you might have lower income, perhaps during a sabbatical or reduced work schedule before full retirement, you can minimize the overall tax impact. The coordination becomes even more important when you consider state taxes. If you're in a high tax state like California, New York, or New Jersey, and you're planning to relocate to a no tax or low tax state in retirement, timing these strategies becomes crucial. I've worked with clients who've saved over $50,000 annually just by coordinating these three strategies effectively. The key is having a plan and being proactive rather than reactive. All right, before we wrap up, let me share some common mistakes I see people make with these strategies. The first mistake is waiting until December to think about taxes. Tax planning should be a year-round activity. The best opportunities come from being proactive throughout the year, not scrambling at year-end. The second mistake is not considering the full picture. I've seen people max out their 401k while still sitting on huge taxable gains in their brokerage account, or harvesting losses without considering how it affects their overall asset allocation. Third, don't let the tax tail wag the dog. Yes, taxes are important, but they shouldn't drive all your financial decisions. A good investment that generates some taxes is usually better than a poor investment that's tax-free. Fourth, not getting professional help when needed. These strategies can get complex, especially when you factor in state taxes, alternative minimum tax, and other considerations. Sometimes the cost of a professional advice pays for itself many times over. As you implement these strategies, remember that you're not just saving taxes today, you're setting yourself up for a more tax-efficient retirement. The money you save on taxes today can be invested for your future. The tax-deferred growth in your retirement accounts gives you more flexibility in retirement to manage your tax bracket through strategic withdrawals. And the discipline of regular tax planning creates good habits that will serve you well throughout your retirement years. I always tell my clients that successful retirement planning isn't just about accumulating assets. It's about keeping as much of those assets as possible by being smart about taxes. These three strategies, maximizing pre-tax contributions, strategic loss harvesting, and timing income events, are foundational tools that every high earner should have in their toolkit. If you found this helpful and want to see how these strategies might apply to your specific situation, I'd encourage you to schedule a call with our team at Trellwell. We specialize in helping successful professionals like you navigate the complexities of tax planning and retirement preparation. You can schedule a consultation by visiting the link in the description.